So let's dive straight in. It's a fascinating time for global markets, and I hope you enjoy the next few minutes that we go through some of the stuff globally. Okay, cool. So now, before we start, I have to do the usual disclaimer, and I'll read it out very quickly. The information contained within this presentation is intended for educational and illustrative purposes only and does not constitute investment advice. Do not make any investment decisions or other decisions based on the material presented. We cannot be held responsible for your trading results. For more information, please visit www.tradinghd.com. Not bad speed for a Thursday evening at 7 o'clock in London, was it? That's what the markets do, try to keep you on your toes all the time. And a little bit about myself. I've been in the markets for over 2 decades, traded every market globally, spoken with lots of hedge funds, traded with them in literally every equity market of the world. Here's something nice that Lex Van Dam says about me, which is always flattering when it comes from a legend like Lex, who has been a client of mine in the past, and obviously someone who I respect a lot. So let's go straight in. This is always where we start from. We always start with the S&P 500, and you know, I've been in the business for so many years, it still does not cease to fascinate me that we can have such a tremendous sideways period in the market. So if you started the year, saw where the S&P was on 1st January 2015, and see where it is today, it's totally unchanged. And you can see that basically from this chart here. At the start, we were here, and at the end of the year, we are ending here. Now, after such a long and lengthy bull market, to expect a sideways movement is pretty normal. But what happens if the sideways movement does not continue upwards and it actually decides to reverse? As always, we do not get into the business of prediction. We try to follow everything as it unfolds and use our tools. Now, what's really fascinating to me at this juncture is that the RSI of the S&P on a monthly chart is playing around with the dreaded level of 60. So you see, if you went through my course, which is online, you'll see that I'm a big believer that when the RSI breaks out of a range of 60-40 to the upside, as you saw in 1995, we had a 5-year clean bull run after that. You know, you could have bought anything on this planet and made a ton of money. Same thing, slightly less strong in 04-05, but nonetheless the RSI was about 60 throughout this period. Same thing from 2012 to 2015. You know, something interesting happened in 2015, earlier in the summer when we had that big flash crash. The RSI closed below 60, and now we are failing or pausing at 60. We'll find out soon. So let's look at the weekly. On the weekly chart, and I've shown this chart to you many times before, and I continue to show it in all future webinars because we need to be consistent in how we are applying our methodology. The rule is very simple. When the weekly RSI is failing to cross above a level of 60, you have to take a little bit of a cautious approach in markets. You cannot be gung-ho and all in. When RSIs are above 60, those are the wonderful periods where you can stay invested and ride out the volatility. But when the RSI consistently fails at 60, as you can see in these 3 instances, to all our clients, you know, I speak to some of the biggest hedge funds out there, to all our clients, this was not a surprise. We actually nailed this move almost to perfection, where you can see multiple failures at 60 and then a break that collapsed the S&P 250 points in a straight line. And look what's happening now. Despite this big bounce that we've had, we haven't been able to take the ceiling out. Why have we not been able to take the ceiling out? That's the moot point. The answer could lie in expectations of rising interest rates. The answer could lie in a slowdown in economic growth. The answer could lie in the fact that emerging markets are acting very poorly. The answer could lie that you have a weakening Chinese currency that is exporting global deflation. But the real correct answer is we don't know. Nobody knows what is going to happen next year. All we can say is that we will be ready to be fantastically long the S&P if we can close above this level, retain the RSI of 60, and produce the kind of magic that it did in 2013 and 2014. The proof of the pudding will be very quickly apparent, maybe as early as January this year, to know what exactly is going on the S&P. My contention to you is this, friends, that if this low breaks on a weekly close, we will retest the 200-week moving average, which is at 1760, if we break this. So as a smart trader, what you should do is try to fade the market, try to short the market in the zone, and get out of the short position if you break upside. But if you are right about this, you can make a ton of money in the next few weeks, maybe in the next 3 months, or we can play for this entire down move here. Is it worth it? Definitely worth it if you can time it. So watch the RSI on a weekly close every Friday, and if the RSI is below 60, you can continue to maintain what I call a bearish bias. Let's look at the Nasdaq. The Nasdaq, on the other hand, is in a very, very powerful trend and has just taken out the 2000 peak. As you can see, if I extend this line, sorry I haven't drawn this line, if you just visually extend it all the way here, you can see that the Nasdaq has made new all-time highs this time. So if you're a long short guy, if you want to play the markets like a professional, you can try and fade the S&P, but remain long the Nasdaq. Why? Because the monthly RSI is above 60. And it pays to be long when the monthly RSIs are above 60. So the Nasdaq long, S&P short works quite well for us. And I think there is durability on this trend. Think about it. If you look at the Nasdaq and see which are the big stocks in the Nasdaq, see the top 10 stocks in the Nasdaq, between them, they have more cash on their balance sheet than many countries combined together. So the top 10 stocks in the Nasdaq have got $500 billion of cash sitting on their balance sheets. And these are companies that have now become household names, they've got strong brands, and they've got well-established businesses. Whereas on the other hand, you have a big part of the U.S. equity market, which is driven by energy, which is driven by railroads, which is driven by industrials, that are not able to maintain their strength because they have all kinds of debt problems, they have all kinds of growth issues. So you have a very fractured U.S. equity market today. You have all the money chasing 15, 20 stocks, and you have money coming out of the rest of the market. Now, can this continue for a while? Of course it can continue. How long can it continue for? It can continue, it can go on for months, maybe possibly a couple of years. We don't know. But at this moment in time, the breadth of the market is very narrow, and it's very concentrated in the top 20 stocks within the Nasdaq, and maybe a few stocks within the S&P, some of the good old-fashioned names. So here is the weekly price chart of the Nasdaq. So here on the monthly chart, the Nasdaq RSI is conveniently above 60. We have to be careful because when we go to the next slide, you can see that the weekly RSI, and this slide was drawn earlier this week for your benefit, you can see that the reading is 59.75 on a weekly close. If we are able to close above 60 by tomorrow or by next week, we could get a breakout on the Nasdaq. But if we fail here, I'm afraid even the Nasdaq will set itself up for a slight pullback. And in that case, you may want to consider getting out of your long on the Nasdaq and just running with your short on the S&P. So that's how you prepare yourself for a trade. And these charts help you prepare for it. You don't have to forecast. You follow the price action, and it will get you on the right side. Let's look at another completely different ingredient of the U.S. equity market, or what drives equity markets, which is the interest rate.